Hello, everyone, and welcome to In the Room with Coronation. My name is Arifa Essop, and today I am joined by Nishan Maharaj from Coronation, Head of Fixed Interest. Welcome, Nishan. Thank you so much for joining me, for taking some time away from managing clients' money to chat to me today.
Thanks very much for having me. Thank you.
Great stuff. Nishan, with 21 years of experience in the industry, tell me, how did you choose financial services, or did financial services choose you? What is your backstory?
Yeah, I think it's quite telling that the story behind it is quite boring and unremarkable, just like fixed income is meant to be. So unfortunately, I can't tell you a wonderful story about how I was hooked on investing by the time I was 5, and I, went through buying my first stock at 8 or anything like that. No, unfortunately, it was pretty mundane. Like, I had no interest in financial markets besides reading about it in the newspaper, hearing about the rand and what was happening and stuff like that. And it continued like that. In fact, I wanted to be a scientist. What scientist? I'm not too sure, but it was some version of science that I wanted to be involved in. And I went through to varsity. I did a pretty generic honors degree in, I think it was applied maths and computer science. Um, and then one day I got a call from Standard Bank that offered me an interview at their graduate intern program. And I wondered to myself, like, how actually did I get this call? It was actually my mother that filled out the form. She said, "No, you're going nowhere in your life. You need to actually go out there and find out what's happening in the real world."
There you thought it was divine intervention.
Yeah, and I thought it was actually my outstanding academic record that got me the call, but it wasn't really. So yeah, I joined the graduate program. They have this thing where you rotate around. I went through global markets, and I think it really sparked an interest in me. And I've always been a very curious person. So I've always, if I find something I'm interested in, I tend to dive head in, try to explore it, try to get to the bottom of what drives it and understand it fully. And yeah, within that global markets division, I joined the interest rate derivatives desk as a sort of like a desk support person. So like when anything broke, I tried to fix it and stuff like that. And yeah, I got a break when one of the guys on the bond desk left. And they asked me, well, you've been asking the right questions. Would you like to learn more? And yeah, it was just sort of a very steep learning curve for the next, I think it was 3 or 4 years, learning about bonds, learning about interest rate swaps, derivatives. And it was a great environment as well, because, people were very encouraging. They afforded you every opportunity to learn, as long as you were willing to take it. And I think, yeah, I just dove headfirst in. I was there for about 8 years. And during those 8 years, as you come to terms with investment markets and, what they mean, I realized that, this was just the tip of the iceberg. And I wanted to learn more about investing and, and what it meant and how it affected the everyday man. And then, yeah, I made the transition to investment management. Yeah, it was quite difficult at first because it's quite a break in thinking, quite a break in it's quite a paradigm shift as well. But I think, because my sort of underlying thinking has always been longer term, and my philosophy around investing sort of, was modeled around that, it made the transition to Coronation much easier. And then I've been here, 13 years, 12 years, 13, I can't remember, but a long time.
So thanks to your mom.
Yeah, pretty much. Yeah, thanks. Otherwise, I would have never been here.
For sure. But what would you say are some of the big lessons you've learned over the last 21 years that you take forward from Standard Bank into Coronation?
Yeah, I think, those lessons that you learn are they're quite intertwined between your personal lessons you learn about yourself, and then obviously the lessons you learned about investing and stuff like that. I think, but when you break it down, I think the most important thing to understand is that, a good investor understands how they make decisions. And you need to break down your own decision-making process in order to understand, firstly, where do your biases lie, and try eliminate them. Try and eliminate the emotion that goes into making a decision. Because you want to make the most objective decision that you possibly can, and that's incredibly important. And I think one of the key things that it's probably taught incorrectly in schools and stuff like that is that, the first person to answer is generally regarded as the smartest person in the room. And what you actually need to do when it comes to investing, especially if you're investing for like a 5, 10 year investment horizon, is slow your decision process down. Make sure that you understand the little fragments that are going into it. Make sure you're eliminating the biases. Make sure that you're not making a 5 to 10 year investment decision in 2 seconds. Sometimes slowing the process down is much more important than the actual decision at itself. And then I think when it comes to investing itself, you know, that refinement of that decision making process, don't expect to get it right straight away. It takes years to refine it, to re-input. It's like a sort of a very iterative process where where you learn from yourself, about yourself, and stuff like that. And I think when it comes to sort of investing, some of the key things around that decision making really impacts how you think about investments. And I think one of the key things I've learned is that, you know, as important decision making is, remember the input into the decision making is equally important. If you put rubbish in, you're going to get a rubbish decision out. So make sure you spend enough time gathering the right amount of information and, most importantly, the right information that's pertinent towards that. And I think, we tend, no matter how much we try to eliminate emotion from our decision making process, it's always there. And you always need to rely on something else to provide a sobering effect to that emotion or to gut instinct that might prevail. And for me, that's always been valuation. Let valuation guide you. It gives you that sort of objective outlook in terms of, how negative am I about this? How positive am I? Am I, exaggerating what's the emotion behind the scene into the decision? And I think that has guided me significantly through, the quite treacherous terrain that has been South Africa and global fixed income over the last 10 years.
And we're going to come to that just now.
Yeah.
But what moment would you say is your most proudest moment?
Oh, it's yeah. I mean, generally your proudest moments come from the lowest points in your investment cycle, because it's those are the ones that make you. And I think there's been a few across my career. I think the first one is probably in INN8. We had taken quite a contrarian view, an opposite view towards the market. I think we were still in this massive SA bull market. We had taken the view that the fiscus was under pressure, it would materialize and stuff like that, and we had positioned the portfolios quite negatively. So we'd taken quite a bit of flack from investors for underperformance, and of course that turned around significantly in December. When was it? 2015 already. Wow, that's a long time ago. And we were validated in that. And then similarly during COVID as well. I think in all of that volatility, in all of that chaos, being able to calm yourself down and be able to, again, focus on the valuation, focus on what the valuation is telling you, understanding the buffer you have in it, and then having the conviction and the courage to actually, follow through on those decisions in a meaningful way within the portfolios. I think that was quite significant, and it was also against, to some degree, against some of the internal sort of discussions we were having at the time. But being validated over the longer term was very rewarding, and something I think we can be proud of. Yeah.
Okay, so Coronation's investment philosophy is, so you describe yourself as active valuation driven. You've touched a little bit on valuation now. Are you able to unpack what that means for investors?
Yeah, look, I mean, so we're what do you call a bottom-up investor? So we focus on understanding the fundamentals that sit behind an investment case. I think it's probably easier to explain it in terms of like a stock valuation because I think fixed income can get a bit confusing. So yeah, it's like understanding what's going to drive the performance of that company, what's going to drive the earnings of that company, what's going to influence the long-term earning prospects, breaking down those factors, understanding them, and more importantly, understanding the risks around those, putting those back together and coming up with a valuation. And that valuation is an indication of what we would perceive to be the fair value of that instrument, and then having the courage or conviction to act within a certain band around that in order to incorporate that asset. It's like, simplistically put, it's like this book on the table. Like, how much does that book cost? Physically, to make the book is not a lot. It's the intellectual property right the intellectual property that comes with that book that enhances it. And I think that's what we try and do is separate those parts out to establish a true value for an asset.
And remove the emotion.
Remove the emotion with it, exactly. Yeah.
Okay, so I just want to get this. Your recent article entitled "A Year of Reckoning" was quite interesting, and you talked about uncertainty and volatility, and you alluded to quite a few of the crises that we've had in financial markets, such as the COVID crisis, the banking crisis, geopolitical tensions. Policy missteps in South Africa. Given this ongoing certainty and the recent banking crisis in the US and the EU, what is the impact, or how does it impact your view on fixed income investments from a global perspective?
Yeah, I think, a wise man at Coronation when I first joined told me that we don't avoid risk as investors.
Who's your wise man?
I don't inflate his ego too much. No, it was Carl Leinberger, the CIO. So he said, we don't avoid risk within at Coro. We price risk, and we ensure that we price risk appropriately for appropriately for the risks that underlie that as well. So I think, within this volatility, within this uncertainty, there's a tremendous amount of opportunity that presents itself, and it's an opportunity for us to take advantage of for our clients. So I think from a global perspective, the COVID crisis, the knock-on impact of that, the geopolitical risk, all of that has led to a significant repricing in global fixed income. I mean, U.S. bond yields are now at the highest levels they've been at in umpteen, well, if you exclude the last 6 months, but in umpteen years, global credit spreads have been incredibly wide. So there's a significant opportunity set there, that's willing that one can exploit, but you have to have the right tools to be able to understand the valuation, to understand the risks that sit behind them, understand how everything fits together. So, I think there is a significant opportunity within global fixed income currently that hasn't been present for the better part of 10 to 15 years. And it's something that we're not ignoring within our own portfolios. It's something we're employing significantly. And then on the South African side, there is significant risk, but there are, areas of good value that sit there that we can also exploit for our clients' portfolios.
And does the risk change for you when you're evaluating global versus local?
Yeah, so when we're constructing our portfolios, it's looking at the valuation of each of the individual assets and how they effectively stack up. Obviously, there are certain characteristics within certain assets that we would include because purely of their characteristics. So, for instance, like U.S. Treasuries have long been safe haven assets that you hold within the portfolio. So, when you're lifting your global credit allocation, your global fixed income allocation, you need to incorporate a decent amount of U.S. Treasuries as a risk sort of offset within there. So it's a combination of, how does the valuation stack up between all of these assets, and also what characteristics or offsetting or diversity do those assets bring to the portfolio. Also, there's within the portfolios, when you're stacking them up, there's sort of substitution effect in the sense that, do I buy local credit? Do I buy global credit? And there are the comparisons you can make where you say, well, global credit in the same sort of entity offers me better diversity, better valuation. I'd rather own that than local credit. So those are some of the decisions that go into deciding which asset to go into.
Was there ever a time that you went against your philosophy?
No,
or
I don't.
Coronation
The
philosophy.
Coronation. Yeah, I wouldn't go against my personal philosophy. Yeah, I don't think. No, I mean, I think the philosophy around long-term active investing, I think it's broad enough to encompass various decisions made at different points in time. But I don't think I've directly been opposed to philosophy. I might have made a decision ahead of time or after the fact, but never against the philosophy.
So not a rebel without a cause. Just
No, not really. I think Coronation's also been around for 30 years. So the philosophy and the process that sits behind our own investment process has been quite tried and tested. Of course, the tools have changed within those processes, but with something with such a long track record, I mean, it's difficult to find drawbacks. That would encourage you to go against the solid philosophy. And also, I think the one thing, being a value-driven investment house, you tend to be slightly contrarian in the way you look at things. So I think when you're thinking about the investment decisions you're taking in the market, they're already against, the sort of natural momentum or flow in the market. So in a way, if you are a rebel, that's a way you can express yourself, or you feel you get your gratification out of that.
How is Coronation different to what others are doing in the market?
Yeah, look, I mean, I think from a philosophy and process perspective, I mean, as you said, we're an active, value-driven house. And there's many out there, Alan Gray, Ford, the like. There's top-down houses, the momentum houses. So they all have their place, within the framework. But I think what really differentiates us is the people. In the end of the day, you can have a wonderful process, you can have, the greatest thing on paper, but if you have the wrong people that are implementing that process, it's never going to work. So I think we place a significant amount of emphasis on the people that are employed, how they are managed, the freedom they're given, and also how they incentivize to best align with client initiative, with the client prospects as well, or client objectives.
I really want to talk about that
Ah,
just now.
okay,
But I just want to remind the audience, please remember to put your questions in the Q&A for us. We will get to them shortly. I see them coming in fast and quick. Well, the same thing, right? But let's try and get those questions through as well so that we can pick your brain a little bit.
sure.
So about the culture, let's talk a little bit about that culture, okay? So how do you prioritize fostering that culture of continuous learning and development? What do you guys do to motivate the staff in terms of that?
Yeah, look, I mean, I think that process starts very much from the recruitment phase. So our recruitment process is very much focused on, you know, people who are ambitious, who are entrepreneurial, people who are very curious, you know, people who are willing to look outside of work outside of their comfort zones for significant areas of time, and it gives you sort of, I wouldn't say a boundary, but a sort of framework for the type of person that we think would be a coronation person. And then once that person joins, that's when the real work starts, because then you got to foster those things, you got to mold those things, you got to ensure you're guiding them, but not forcing them in the right direction. And we spend a lot of time discussing you know there's no structured peer point, but on an ongoing basis, in terms of each individual within the investment team, how they're performing, how we can help them better, what can we provide for them that would better support them in their journey. And it generally takes somewhere anywhere between 2 to 4 years before, I hate to use the word, but assimilate someone into the coronation culture. And it's generally at that point that we can say, oh, okay, that's a Coro person now. And I think that investment really pays off over the long term, because you create people are here not because they're forced to be here. They want to be here. They want to work in the environment. They want to be pushed. They want to explore things outside of their comfort zone. So we don't, if someone's in fixed income, it doesn't mean you only look at SA government bonds and credit and listed property. You can look at equities. You can leverage off the team. There's no silos within our environment. You can really traverse laterally between our investment team. It's fully integrated. There's no silos. There's a huge amount of cross pollination, and that really keeps people stimulated and keeps them going within markets. And it leads to a culture where people want to be here, where people want to perform at 110, 120%. And I think that's very important, specifically in the investment environment.
Tell me more about that. You talked about leveraging of the investment team. So, are you saying that fixed interest research analyst would work in the equity team as well, or are you saying they just leverage the knowledge of that team? How do you work together as an investment team?
Yeah, there's a few ways. So, I mean, I don't think fixed income analysts would take the role of an equity analyst, because inherently the way we think about things in our makeup is a bit different. I mean, they're a bit more loose and fast. We're the long term guys. But no, so what we effectively do is we leverage off their knowledge, and their knowledge not only of the companies but of the sectors. So at a credit level, we would use their knowledge on the company that we're investing in or that we're lending money to incorporate it into our analysis of the underlying company. Also understand the sector, what's driving the sectors, and how that can shape the investment over the longer term. Then we would also use like a broader indication of financial health within the South African economy, by looking at those companies and their earning projections and stuff, and we bring that into our economic research. So, like for instance, one of the big things we did in I think it was 2020, towards the end of 2021, is that we looked at the earnings that were coming out of the many of the mining companies, and we saw, obviously, because of the commodity boom, there was a significant impact on their earnings, which obviously meant that there was a significant impact on the tax revenue take. That would have gone up significantly, and it would have led to a much more significant rehabilitation of the fiscus at that point in time. And that sort of integration allowed us the opportunity to take advantage of bond yields at that point, benefit from the rally that came as a result of that. So there's numerous examples like that, not only in the local space, but also in the global space, where we implement very much of a similar framework. And then again, you do have our hybrid asset classes like listed property, which are a little bit fixed income, a little bit equity. And what we do is, actually, as part of that entire process, there are equity analysts who are actually part of the sort of broader property team that will perform the research on those individual stocks, and that allows as well the fixed income analysts within the property team to leverage off them and to create a much more robust investment process.
And view. Okay, so you're literally leveraging off each other and working together to provide
Correct,
the
yeah.
best outcomes for your clients,
Exactly.
which is
I
great.
couldn't have said it better.
Ownership structure.
Yes.
I read that Coronation is 29% employee owned.
Mm.
How does this ownership setup influence the way you make tough calls when things get rough?
Yeah. Look, I mean, I think, especially as a long-term house and an investment house, you have to have your objectives aligned, not only from an investment perspective, but a personal perspective to your clients. So you can really understand that. I mean, so I think, having that ownership structure allows people to think like owners and to think like, obviously some of our funds of our long-term incentives are also deferred into the funds we manage. It allows us to think as underlying, put ourselves in the shoes of the underlying investor, and this helps for a closer alignment of our objectives to the underlying investor objectives. So like from that perspective, like my dad is invested in one of the funds I manage, so that also
Out of duty?
No, I don't think. Hopefully not of duty. Hopefully not. But he's the most difficult client I ever can manage in my life, because I mean, he thinks he's got a hotline to the guy who can tell him what to do at any given time. So, it's sort of, it also helps, understanding managing your own money, or understanding people that are close to you, who have money invested with you, trust you with their money, to understand what that trust entails, and to employ it within your investment decisions. So, make sure you're doing the work. Make sure you're understanding the risks that sit behind the investment case. And I think that ownership structure really allows for that, allows you to, take that extra step when it comes to managing your clients' money.
Do you get asked often that what should I be investing in? Like you're sitting at a family braai and somebody says, help.
Yeah, look, I mean, my wife always laughs at me, because like if I ever enter a new environment and someone asks me what I do, I say, I'm a landscaper or something like that, because you never want to have those questions, because inevitably they come along. But yeah, I mean, it happens often, and I mean, naturally you want to help the person and stuff like that, but it takes you, you always want your personal life to be separated from your work life, so you have some break. Otherwise it's just one continuous flow into the other. So I try and, I wouldn't say squash the conversation, but provide a concise answer that provides no need for reciprocal questions from that perspective. Yeah.
Or just confuse the hell out of them, so they're like, okay,
Yeah,
I
I
can't.
use a lot of high words. Yeah.
Yeah. So you spoke a little bit about incentives earlier on.
Mm.
How does Coro ensure that the incentives for its staff are aligned with the interest of the organization?
Yeah, so we're very much a performance-driven culture, and that's reflected in the way our remuneration structure works. So, if you think about our base salaries, they are slightly less than what the market offers. So it really incentivizes you to put the best behind your performance, because that performance bonus and stuff like that is what will bring you back up to par. And then within the bonus structure itself, only less than 50% is allocated in cash. The balance is allocated to the bonus pool, and the bonus pool then makes decisions around where to invest it. That would either be in Coronation um, unit trusts, so we'd invest in our own funds that we manage, or it would be in Coronation shares. And the final one is that the vesting period is exceptionally long. I think it's close to 5 years now. So
Helps with
it's
retention.
yeah. So it helps with retention. It also helps, again, aligning the objectives to the client objectives as well, and that's very important. Yeah.
So one of the questions I did have was, are you invested in your own fund?
Yes, I am. Yeah, we are by nature invested in our own
Out
funds.
of choice again, or
Well, I would be invested in the funds anyway.
you're just saying that because all your bosses are listening, right?
Hopefully not.
Okay, we're going to jump to questions from the audience.
Sure.
I have some interesting questions. Let me just pull them up. Here's a question from Anonymous. You spoke about the importance of people.
Yep.
We are living in a world where AI is becoming very relevant in all industries.
Mm.
Have you adopted this, and how do you keep the balance between AI and people?
That's a great question, actually.
Yes.
It's the first time I've actually been asked that. Look, I think AI is definitely come up in leaps and bounds, and it's definitely been incorporated into the broader business in much of the process-driven part of the business where AI can be helped to speed up this process, increase efficiency, and stuff like that. I think on the investment side, it's going to take a bit of time because inevitably there needs to be a bit of human discretion that comes with the decision making around investments. But it's not to say that in the process of refining the data, in the process of refining your inputs that go into your sort of modeling process or your analysis process, that you can't incorporate bits of AI into there to assist you within there. But I mean, are we using it as a replacement for an investment professional? I don't think we're at that point yet where we can comfortably make that sort of assessment or around the merits of AI versus an investment professional.
Do you think as South Africans we lag in terms of what's out there from an AI perspective?
Look, I mean, I think as an investment industry, we definitely up there, and we compare quite favorably relative to some of the best investment houses in the world. I mean, I think there's some exceptionally gifted investment professionals here, not only at Coro but across the industry. And I think as such, we never really lag the trends that would be coming within the investment industry. So I think from that perspective, we don't lag the trends. I think we are at the forefront of those trends, and we are able to capitalize on them when they sort of when we see the benefit.
How does Coro or Nishan feel about blockchain? And that's just in relation to the previous question about AI, because it's not very regulated
Yes,
at the
yes.
moment. And so do you see that playing a part in fixed interest?
Yeah, look, I think we need to make the distinction there between blockchain and
Crypto.
and Bitcoin,
Mm.
or what's the term now? Crypto.
Crypto.
Crypto, yeah. So I think crypto has gained a lot of credibility as an alternative store of value. And you look, I mean, I think if you think about it in terms of like how you would think about gold, there is some sort of sense of value there that one can look at. And definitely, we've seen the popularity increase a lot. Is there, as a valuation-driven investor, it's difficult to really put, your finger on it, because what's driving it is more what's driving is almost the antithesis of what's driving everything else.
Or sentiment.
Yeah, exactly. But it's also, because it's an alternative store, it's like what's happening everywhere else. Because there's nowhere else, therefore we go here. So it's a bit difficult to put in from a valuation perspective. But blockchain is something, the technology behind it, blockchain, I think definitely will go a long way in changing the face of the banking industry, maybe even changing the face of the investment industry, because of the security features it offers, because of its replicability, and stuff like that.
Yeah, definitely. Here's another question from Yaku. Thank you, Yaku, for your question. How has issuance by the SA government changed since the beginning of the year? Is Treasury issuing on the short or long duration side? And how is the market's appetite for issuance?
Yeah, that's also another great question, and it's something I think that, goes to the heart of South Africa's problem. So we all know South Africa has a fiscal problem, and that fiscal
Mhm.
problem it comes out of the fact that, we grow at a very low growth rate, but we fund at a very high rate. So we basically fund ourselves at a weighted average of around 10%, and we're growing at 5 to 6% normally, over the longer term. So effectively, we're growing less than the rate at which we're funding ourselves. So the structure of our issuance has a significant impact on the fiscus as well, because you want to bring that cost of borrowing down significantly. Now, we know that cost of borrowing, like in global markets like the US and Europe, has been artificially brought down through the use of quantitative easing and the like. But South Africa is an emerging market, and with a very orthodox central bank, that's probably not on the horizon, until things really get bad. So the best the Treasury can do is actually, change the structure of the issuance. I think unfortunately the Treasury has been a bit slow in doing that, but they are definitely embracing that now. So, previously we used to issue everything in the fixed rate market and the T-bill market, and there was nothing else. There has been the introduction of floating rate notes as well now, that are now, a benchmark of JIBAR, that effectively at the short end of the curve, that bring the cost of funding down. Fixed rate issuance has now moved slightly towards, sort of around the 10 to 15-year area, but still the weighted average is still significantly longer than we'd like it to be. There's been more engagement in concessional financing from offshore entities like Development Bank, World Banks, and the like, to sort of fund South Africa. So that's also helped to bring down the cost of funding. But we do think that structure of issuance can change significantly, can change much more significantly. Move it more towards the shorter end curve, move it more towards something towards cash rates. We already have a very long maturity profile in our debt that allows us to, do this for the next 3 to 4 years, while the reforms get implemented, while we hope for growth to, kick back up. That will provide some breathing room. So the Treasury has reduced the amount of issuance very slightly. They probably might reduce it even further come MTPPS, but not significant enough to take the pressure off the bond curve.
And globally, interest rates have been increasing due to
Mm.
inflation. You've heard this question a few times, I'm sure.
Mm.
South Africa's continuously increased their interest rates as well. From a global and local perspective, when do we expect interest rates to start falling?
Yeah, so definitely globally, the inflation picture is a lot more murkier than it was. It's a lot less clear cut. We do think inflation will come down over the longer term, towards the targets, but I think the central bank's ability to maintain inflation at their targets has been quite reduced. There's been a lot of structural changes with deglobalization and stuff like that that will support higher inflation. But we don't think, at least for the next 2 years, the narrative hasn't changed. We do think rates globally will come down. Some will come down more than others. Like we think Europe will come down a lot quicker and more because of where they currently sit. The US will take longer. But definitely, rates will come down somewhere between 150 to 200 basis points. South Africa it's a bit trickier because, so although we see inflation coming down in South Africa, we see it going back up quite quickly and staying, around about 5.5%. And that's because there's also been changes in South African economy. Firstly, the cost of doing business in South Africa has gone up significantly with load shedding, with the failure of transport networks. Then, of course, you've had the rand that's remains significantly weaker and will probably stay weaker until the fiscal problems rectify themselves. Then there's sort of fair value, which also adds pressure on imported inflation. So all of these factors will keep inflation higher than we would like. So, the SARB target's 4.5%. It's probably going to be above that over the longer term, which limits the SARB's ability to cut rates. Then you throw in as well the fact that the SARB also wants the inflation target changed. So we know they target the midpoint of the band, which is 4.5%. They sort of want it to be moved to 3% plus or minus one. If that change occurs, then the ability of the SARB to reduce interest rates basically goes away. And rates are going to stay at this sort of 8.25 level on the repo perspective for quite some time before you see the effects of, those higher rates starting to make its way through. So, South Africa is a little bit more difficult to call, but we don't think there's any more hikes. I think that's the most important thing.
So I recently read something about second half interest rates will come down in South Africa.
Hmm.
Not.
Look, I mean, I think if the inflation target in South Africa changes,
Mm.
I don't think that would be the case. But if it doesn't change, I think, yeah, we can
Possible.
count on rates coming down probably in November of this year. But again, it's not going to come down from like 8.25% to like 3.5% that was previously. It's probably going to come down from 8.5% to 7.5% over the next, for the 9 months after that as well.
So minimal,
Yeah,
not what people are expecting, this big
correct.
boom, and which will translate into higher growth for SA.
Yeah,
Mm.
correct. And I think, part of the problem is that globally rates are higher and real rates are high. South Africa is a capital hungry economy. We need money to flow in. The only way you can attract money is by high real rates. So unfortunately, until you get a correction on the fiscus, that gives people more certainty around investments and an increase in growth, you have to find a way to attract the capital, and that's the only way that it stays, that it attracts capital.
Here's another question from Anonymous. Industry flows have increased to fixed interest or over recent times. How will this impact price and therefore yields? How will it impact price and yields?
Yeah.
And therefore, or what risk could this increased flows pose?
Yeah, that's another great question. I think it's quite an educated audience here. um,
Nothing but the best.
So I think very true. The flows to fixed income have increased, but I think you need to look at where those flows have actually come in. So it's been significantly in the multi-asset income fund category where those flows have come in. So the assets under management there have grown. I think it's two and a half, threefold over the last 5 to 8 years. And you can see the amount of funds that flowed in have created an increase in the amount of funds within that sector as well. So I remember when I joined Coro and I was, made co-manager on the strategic income fund, there was only really like 5 or 6 income funds in that category. I think now there's well over 100. So there's been a large amount of entries, and with those large amount of entries, there's a significant divergence in how guys are perceiving risk and how they are trying to achieve return objective for the clients. Also, within that income fund category, there are very little actual limits. Most of the limits that are set inherently by the investment house or the manager, in terms of we believe to achieve this, you don't need to go out of this band, whatever the case may be. But because there's such freedom there, it allows people to push the limits. Something that's also added to that has been the fact that the gap between cash and bonds has increased significantly. So previously that gap used to be like 1.5%, 2% at most. It's now significantly more at like 3, 4, 5%. So it also allows for more risk to be taken in that category, and we can see that happening. There are funds now that are taking significantly more risk than what a traditional income fund used to be able to take. There are funds taking significantly different types of risk, like in terms of credit. We've heard about more recently the sort of credit event that occurred within one of the income funds because of this exact reason. Money flowing into the sector, not enough opportunity set within a shrinking economy, therefore forcing managers to go into what we would call higher risk sort of instruments, or instruments that have a higher risk than is needed for the underlying income investor. And then, credit in South Africa is a discrete sort of, it occurs on a discrete event. And sometimes one day you have your money and the next day you don't, and then these sort of events occur, and this is a symptom of what you've actually been about the flows into the sector.
What would you say are some misconceptions about the fixed interest market that investors hold?
Yeah, so there's a few. I think so. First and foremost, I think fixed income is not always safe. We mustn't forget that we operate in an emerging market that is South Africa. So not all investments in bonds are safe. The recent income fund credit event is a perfect example of that. This is supposed to be a conservative fund investing in conservative instruments.
And you've lost me.
And they've lost, I don't know how much they've lost, but there's a significant amount of money there. So I mean, I think investors, when they're looking at the fixed income product that they're investing in, they need to understand the risk. You need to understand the risk. You need to understand what drives that risk. Don't just think about it as just, it's a bond, it'll be fine. I'll get my money back. It's
guaranteed.
It's guaranteed. Yeah. Or there's a yield there. I can count on the yield. The yield's there until it's not. So I think that's the first one. The second one is incorrectly comparing the risk return sort of characteristics of fixed income with equity. So with equity, these guys are rock stars. They go buy a share, it goes up 10 times in price. everyone's happy, right? I
I'm
mean, but
sensing some animosity.
no, no, no. It's just, it never. It's no. It's just the
No,
nature of what
I'm
they do.
joking.
So, but with fixed income,
Hmm.
it's not the case. You're never going to make. You'll be very lucky to double your money in 5 years. And even then, too, you're probably investing on the higher end of the risk
Mm.
spectrum. So, remember, fixed income is about trading time. Every year you can get that yield in. It's the yield that you can count on,
Mm.
and in order to count on getting the yield, you have to make sure that you're getting your capital back at the end.
It's about
Um,
consistency, right?
Correct, exactly that. And I think there's that incorrect association between equity risk and fixed income risk. Like if you buy, for instance, I'm just using company A shares, and those shares go up 50 times, you think you should own the bond, but maybe the company is going up so much because it's highly leveraged or whatever the case may be. So I understand the differences there. And then I think this is in like a sort of inherent misconception with investments is that that instant gratification. When someone invests in something, I want to make money tomorrow. It has to go up 3 4 times. Understand that true wealth is built over time. It takes time to make money. It doesn't. There are a few lucky individuals who do it quite quickly, but to build true wealth, it takes an incredible amount of time.
How do you send that message out? So you spoke about a lot of things, right?
Yeah.
Consistency, high. Cannot compare it to an equity investment. It's priced differently. It's about understanding that risk. How do you
Mm.
manage that and send that message out to our clients? How do you land that?
Yeah, so I mean, I think there's a significant amount of interaction that occurs between us and the clients. That's the one thing I underappreciated when I transitioned to the investment industry is how much of your time actually goes in distilling what you're doing in your portfolios in the simplest form and the simplest explanation to the underlying client, so they can understand what you're actually trying to achieve. And the second thing is obviously having, an incredibly talented institutional team and retail team who actually understand the portfolios, who understand the way we think about risk, who are very closely aligned to the way we think about things and are able, more importantly, to communicate those messages to clients. Because the last thing we want to do is be is having to spend 90% of our time, seeing clients and going through this explanation process and only spending 10% of time on the portfolio.
Manage.
So we also have this incredible team that sits around us that absorbs the knowledge, that absorbs the communication, the stuff we talk about, and disseminates that correctly to clients. And I think that's very important. Yeah.
Do you find there's a mismatch between what we tell financial advisors, a lot of whom are on this call, and versus what they say to their clients? Is there a gap between that?
Yeah. Look, I mean, I'm not gonna lie. I mean, it's I envy
Hope
the
not.
job. I don't envy the job of financial advisor. It's incredibly difficult because I mean, again, you're trying to explain something that's probably quite complex in the simplest form to the end user. And of course, there's some things that get missed along the way. But generally, we find, I mean, the way the investment industry has evolved over time, the knowledge of the financial advisor, the knowledge of the individuals that disseminate that information has increased significantly. So there has been definitely an increasing standard in terms of communication to the underlying investor and in terms of the underlying investor's understanding of the products that they are invested in.
Do you ever get clients coming to you directly, like bypassing?
Yeah, we do. I mean, our I shouldn't say this, but our email addresses are quite easy to figure out. So we do get a lot of questions directly from clients. And look, I mean, we answer them. I mean, I will answer. I mean, I get at least 3 or 4 mails a day. Obviously, some of them are much more. Can you tell me how much of your fund is in this? Then I give that to the institutional retail
Yeah.
team to answer. But if it's more in-depth questions, yeah, we always take the time, to answer those questions and to help clients. I mean, even inevitably, it's their money that we're managing. So we have to make sure that they are comfortable with the way we're managing it and the process behind the management of that. Yeah.
For sure. I want to talk a little bit about the indicators that you monitor when you assess the health of fixed income markets. How do you identify opportunities for yield?
Yeah. So there's numerous, I mean, there's different portions of the fixed income market and there's different indicators we would use in there. But, I think all of these indicators that we use form part of the input into our sort of valuation process and output a sort of and the output of a sort of fair value indication. So, for instance, we would say like when markets become incredibly liquid, specifically like for instance in credit markets, we would say, there needs to be a higher risk premium or liquidity premium embedded within these instruments, and that would require the fair value to effectively decrease or increase from a yield perspective, and that to compensate us for that liquidity risk. So there's a huge amount of things that go in there. So I think from a government perspective, government bond perspective, it would be inflation, growth, the fiscus, what's happening in global fixed income markets. How is that going to impact the local market? So those are some of the things there. And then from a credit perspective, there's a whole host of things that go in there as well. There's the health of the company, their leverage and stuff like that. So I mean, most are stock standard things that you can pull out, but again, it's how you interpret them and how you input them or how you input them into your process to create the right output, that you can value.
I want to talk a little bit about credit analysis
Mm.
because that comes up quite a bit. Um, it's like examining someone's financial health before you invest or before you lend them money. Okay,
Mm.
essentially that, and that's a simple way of putting it. How does your credit analysis process inform the decisions you make within the portfolio?
Yeah, I mean, I think that's actually a very great, sort of summary of how we effectively do that. It's assessing the financial health of the entity that we're lending to, not only from a quantitative perspective. So not only checking, where is their net debt to EBITDA, where there's interest cover, or whatever the case may be, but also understand the qualitative elements that sit next to that. How invested is the management team into this, and the like, and then understanding the trends that are driving that industry as a whole. So, if you're lending money to a mining company, understanding where you sit in the cycle, understanding, you know, that these cycles can be quite volatile and turn quite quickly, and that you need to price for it. So there are a numerous amount of qualitative adjustments that need to be made to the quantitative inputs that go in there. Um, and it's keeping it as simple as possible. Don't overcomplicate stuff. We don't have this massive or this black box sort of credit model where you put stuff in, gives you an answer, and you're like, wow, that's great, and put it in there. But it's understanding the inputs, making sure you understand why that output is coming out, and then it's the continuous reassessment of that. You know, People often forget that these companies report every 6 months or every 3 months, and that you need to be on top of that in order to understand how the valuation changes. Don't just put it in there and say, this thing's never going to remark. It's going to do its job for the next 5 years. I don't need to worry about it. That's definitely not the approach. You need to consciously reevaluate that valuation and understand how not only how the company fundamentals are changing, but as I said, the sector fundamentals. Are there any structural constraints that you need, kind of structural changes within the industry, within the regulation that you need to be aware of? All sorts of things. That make your process a lot, that make our process a lot more robust.
I have another question from our audience,
Hmm.
from Anton, who says, how has the changes to the Reg 28 impacted your funds with regards to offshore asset classes? And has it benefited your end clients?
Yeah, so in fixed income, I would say it's not as significant because many of the fixed income investors use our funds as building blocks. So we're not utilizing the full 45%, but we are utilizing a significant amount more than we have utilized previously. I think within our bigger multi-asset balance funds and the like, that's where you're seeing the significant difference and the significant uplift to investor objectives. Um, I mean, I think the lift to 45% occurred at uh, quite an opportune time. Not only was South Africa going through entering a period of like sort of decline, but then global assets repriced significantly. As I said, global credit spreads widened, global bond yields increased quite significantly. So it allowed you the opportunity to now include these assets in your portfolio in a much more meaningful way. And as a diversifier away from South Africa. So I think, it's definitely benefited the clients because you are now getting access to names that you would have never had access to before within the fixed income space and also obviously within the equity space. But I'm gonna stay in my lane and talk about fixed income. I think definitely from a fixed income perspective, you're getting exposure to, highly rated companies, trading at incredibly cheap valuations, that when you incorporate into your portfolio, just enhance the quality and enhance the upside of your portfolio.
Nishan, earlier on you spoke about the investment team pretty much determining how or what goes into the fixed interest portfolio. So
Mm.
you've got full say in that matter. Do you think that that leaves you or other fund managers at an unfair advantage because it's essentially determined by the fund manager, the portfolio manager? So in determining what goes into those
Mm.
portfolios.
Yeah, so I maintain, full responsibility for the management of the funds and all the decisions that are made within the funds. But you mustn't forget that we feed off an investment process that's quite robust. So within that process, there are, like, just to give you an example, like on the credit side, it's not just the fixed income guys that sit there and deliberate on whether we should buy this credit and what's the right valuation. There's like guys from the equity side. There's senior portfolio managers, the CIOs involved in the process. The analysts on the equity side are involved in the process. So there's a huge amount of input that goes into that process in coming up with the valuation, and the debate around it can be quite intense. And I think the output from that process, is then replicated within the funds for, in line with the sort of risk profile. So, we don't believe in management of portfolios by a committee, merely because someone needs to take responsibility for the eventual portfolio.
And that's you.
And that's me. Yeah. Good thing and a bad thing.
No pressure.
Yeah. Because, you need to allocate responsibility. Someone needs to, make sure that there is oversight. When you manage by portfolio, there's too many places to hide behind, this and that. So I think that is the strength of the process as well.
This is me being presumptuous
Mm.
that there is a book lying on your bedside table, read or unread, doesn't matter. What book would that be?
Oh yeah, I read quite a range of books. I also listen to quite a few podcasts. I think, what's changed a lot in the last, I think specifically from COVID, is the amount of information that you can get from podcasts from, you know, highly regarded individuals, highly informed individuals, that you probably never had access to before. So, you can really go down a rabbit hole on a topic in terms of your understanding of it, and your ability to understand it, through these podcasts. So there's numerous stuff like that as well. I think over the years, I mean, my early part of my investment career, I think I spent a lot of time reading some of the books that were there, to sort of understand and get yourself up to speed and stuff like that. But as I said, over time, it actually comes down to understanding yourself and understanding the psychology behind decision making, understanding what drives that. And I think that's sort of where the type of books that I've read that I've started reading in the last 5 to 8 years has changed. It's moved more towards that psychology behind decision making, and then looking at other successful individuals, not within the investment industry, but could be in innovation technology, in the motor car industry, whatever the case may be, um, and understanding how they make decisions, understanding what drove them. So you can pick little bits and pieces. Sometimes you can read a book and come away with only one useful thing, but it's fine. So to answer your question in a very long and roundabout way, I'm currently reading Elon Musk's biography.
And how's that going?
Yeah, it's interesting. I mean, it's quite interesting. I mean, the man has a significant amount of conviction and courage behind many of the decisions he's make. Leave alone what he does in his personal life and how he perceives it. But I mean, I think there's definitely lessons there that we can pick up on and and utilize within our own framework.
So that self-awareness, personal development is a critical point for you. It helps you with your decision making in the portfolio itself.
Yes, it definitely does. I mean, I think it's very because, as I said, it boils down to the decision you make. There's an analysis, and the analysis that's done. I mean, it is differentiated, but it's the decision that you make in the portfolio that really counts.
Any recommendations that you would like to give to our audience in terms of those podcasts that you were talking about?
Oh, there's so many, so many. I mean, I think depends at what stage in your investment life you are, but I mean, I think there's a few essential ones. I think there's, the Ray Dalio podcast where he talks about his life and how he started Bridgewater. Um, yeah, there's one that I think only the Indian people will understand. It's
Please
one.
share it.
It's, It's not so stupid, but it's the one by Shah Rukh Khan. I'm sure you know who that is, right?
Love him.
Yeah, exactly. And he talks about his life and the adversity he's overcome, coming as an outsider within the Bollywood industry. And I don't go too much into it, but I actually found that quite interesting and quite entertaining. So yeah.
He was actually on the David Letterman show,
Yes,
and
yes.
that was a very interesting stream for me. I thoroughly enjoyed that. He's been my childhood fan from, well, I've been his childhood fan. I hope he knows who I am. But yeah, he's actually a significant character. Interesting bit of news for the audience. There's 7 billion people in the world, and he has 3.5 billion followers.
Pretty much, yes. Yeah. Yeah. So he's definitely doing something right, and there's
Right.
something that can definitely be learned from him.
For
I mean,
sure.
also maintaining humility among that, in that, at that level is quite something.
I'm
Yeah.
going to check that out. Thank you. Okay, Nishan, as we gaze into the future,
Mhm.
which lessons from Coro's 30-year journey do you think will still hold true for investors over the next 30 years? Given that markets and economies change and there's constant volatility, what lessons are you taking forward?
Yeah, look, I think the most important lesson specifically related to Coronation is, firstly, let valuation always be your true north and your guiding star when it comes to investing. And secondly, you invest in the people that are responsible for the process. That is the most important, that's your most important, your critical asset when it comes to the investment world. And you have to, foster a culture that creates an environment where people want to walk into work every day and want to do what they want to do and want to push themselves to the max. I think those are the two key ones.
I'm going to head towards some questions from the audience just before we wrap up. Here's an interesting one from Anonymous. In the fixed interest world, what keeps you up at night? Apart from your 7-year-old.
Yeah, look, I mean, we live in an interesting time, and I think there's a lot to be concerned about, specifically living in South Africa. So, excuse me, I think within a low growth environment that we currently sit in, your opportunities for investments are quite reduced. So, from a career perspective, the economy is not growing, companies are not investing, there's little corporate issuance coming out there, which makes reinvestment risk quite high. Because, as some stuff rolls off, or, as fixed income instruments mature, you need to put the money to work somewhere else, and you can't sit in cash because, what you're trying to achieve is significantly different to that. So it's the reinvestment risk that constantly worries us. And coming with that is, what do you reinvest in? I mean, very from a simplistic perspective, you look at the markets and you say, well, government bonds are 12, 13% yield, but hey, they're there for a reason. They're telling you something about, the probability of default. They're telling you something about the health of the underlying economy. So it's not, as easy a decision as it was, if bond yields were at this level, say in 2019 or something like that. There are significant risks in there. And, I think out of all the things, that's the one that concerns me most because, a loss of the fiscal sort of trajectory or the rehabilitation of the fiscus has quite a detrimental impact on the local economy and the prospects for the local economy.
Thank you. Let's go to another question. Do you anticipate growth in interest from clients in guaranteed or structured solutions due to the current value fixed income instruments provide?
Yeah, so we don't really delve into that, but we are aware of those type of instruments and the growth in them. There's definitely been an increase, specifically from your retired population who need the guaranteed income, with rates being as high as they have been. Bond yields 12, 13%, real yields, being in excess of 5% for most of the ILB curve. There's definitely much more guaranteed product that's coming to market that investors are willing to take. I don't think you can put all your eggs in one basket with those products because they obviously come with risk. But having a portion of your portfolio in them is definitely the right decision.
Does your mandate allow for structured?
Yeah, so we are not guaranteed products.
That's
I
right.
mean, it depends what you mean by guaranteed product, but we do allow structured products. But for us, remember, the big thing is liquidity and transparency. So, all of our money is on a 24-hour notice period. So we have to ensure that the instruments we invest in Firstly, if they're not liquid enough to liquidate within that period, that they're sized according to the liquidity constraints. And then secondly, to ensure that those instruments mark to market on a daily basis. So, or as frequently as possible with the underlying, to ensure that the pricing of our funds are fully reflective, because you never want an investor withdrawing from a fund being prejudiced because a certain instrument is not, that a significant part of the portfolio is not marking the market regularly, and therefore the price reflected is incorrect.
And naturally, a structured portfolio, a structured note it doesn't encourage liquidity, because you've got to hold it for a longer time period, essentially. And there's risks inherent with that. So I can't see how you would.
Well, there are, instances where we would hold. Like, for instance, like we could buy some offshore bonds, swap them back to rand, put them into a structured node, earn a significant pickup. Like, a very simple example is if you buy a South African issued bond in dollars and you swap it back to rand to maturity, you get basically 2.5% excess yield because of the interest rate differential between the dollar and the rand on that instrument. But it's effectively the same credit risk. It's the South African government, but you're getting an enhanced yield there. So in those instances, you definitely are happy to take that liquidity constraint because you're being rewarded for it in the valuation. But of course, because the nature of that structured product is so, I wouldn't say very liquid, but less liquid than the government bond, you can't have it as being 10% of your portfolio. It can be 1%. Maybe.
You would reduce that naturally.
Yeah, the size.
And I suppose that's not something that you're thinking about all the time, constantly, or just buying that willy-nilly.
Yes, of course. There's a lot of analysis goes in. And then, of course, there's a comparison made between that asset and other available assets. Also, understanding from a top-down portfolio risk perspective, how much exposure do I have to South African government? Is it the right exposure? Do I need alternative exposure, etc.? So, there's a few other things that go into that process. Yeah.
I want to thank you very much for your time. We've come to the end of our session. We were not able to get to all of our questions, so we'll send you we'll gather those questions for you and we'll send them to you at the end of this. Thank you very much for joining us. Catch us in the next In the Room shortly.
INN8 is a registered trademark of Stanlib Wealth Management Pty Limited, an authorised financial services provider.